Hello, this is Brian Shannon from Alpha Trends Blogspot. Today is Monday, the 19th of November, 2007, and the market's closed, and we had another tough day for the bulls. Last video I had was Wednesday of last week, and Wednesday morning when the market gapped up on some kind of news, if you remember, I had posted a picture of a horse with a little bow on its head, saying that if you're long, don't look at this picture, meaning don't look at gift horse in the mouth, because as we know, a lot of times prior level of support acts as resistance, and that's exactly what happened here. And the market has sold off pretty dramatically from that level, made a lower low today. So the downtrend remains fully intact here. There is no evidence of a bottom. And if you look at maybe if we take a horizontal line just to kind of show you the levels, we take a look at it, let's just call that 157 up there, and then 149 in here. The height of this move from here to here is about 8 points. So if you take 8 points away from the 149 breakdown level, you could see this market, I still think, down near 141. So there still continues to be a lot of risk in this market. And just as we see on the daily time frame that a prior level of support broken will act as resistance, you see the same thing on the 10-minute time frame today, that this market had trouble at the prior level of support. We'd seen right in here. Now we had this little shakeout last week that trapped some shorts in there, and they got squeezed higher. Then we had this move higher off the 2/3 retracement, if you remember, and that gap trapped the longs in there. So it's a very volatile market. It's not being kind to either the bulls or the bears on an overnight level. You have to be quick to take those losses when the market gives them to you. Basically, if you were short in here, you want to be out quickly when it seems to be recovering, and if you're long, then you want to be out when they fail once again on the downside. Now we have this prior level of support at about 144. Let's just call it 144.50, 144.50 rather. I'm not talking very good. But that prior level of support was tested late in the day, and the market found resistance there. So that is not a good sign for the longs. On the daily time frame, again, we've got the 10-day moving average below the 20-day moving average, below the 50, and the market is also below the 200-day moving average. When we look at the just look at the pattern of lower highs and lower lows. To me, that's what a bear market is. It's not down 10% or whatever. As long as we're making lower highs and lower lows, the market is going to need to recover back above that 149.5 level or so before we have any chance of a real recovery. So don't be looking for the bottom, because it's just there's no real point to it right now. It's also troubling that we're starting to see these levels of the prior highs earlier in the year that then became support now being tested on the weekly time frames. This trend line has been broken on the weekly time frame, so there's still a lot of danger in this market, and there's still a lot of room to the downside in here. It's possible we could see the market back down near the year lows. It's not what I'm calling for, but it's definitely a scenario that could potentially play out, and the path of least resistance is lower. So respect the trend. It's nice to know these, typical stock traders almanac type things about what typically happens on the week of Thanksgiving, but there's no guarantee that anything's ever going to happen. Just as, I've been pointing out Google to look at this as a potential turning place for the market to rally from near this 50-day moving average. We've also seen in here a MACD divergence, but the trend continues lower. We've still got a declining 5-day moving average. There's no reason to buy Google. There's reasons to think that there's a potential for a turn in here, but there's no reason to buy it until price confirms it. Price doesn't confirm this, typically bullish time of year based on Thanksgiving. Price is the only thing that pays. And again, the worst market, the most damaged market, continues to be this Russell 2000. And the message that this market's sending is that we've got further selling coming also in the S&P 500 and the NASDAQ. That's the way I'm interpreting it. It breaks down quicker than the other markets. The other markets seem to follow the IWM. So when we look at the weekly time frame here, you can see that this trend, it's busted, and it's going for a test of the lows near $73. So Continue to be very, very diligent about managing risk in this environment. The more times that support is tested, the more likely it is to fail, and you can keep creating these little head and shoulders patterns all the way down. We see it here on a 30-minute time frame. This one will give us a target of 79 to 76. That's a 3-point head. Subtract 3 points from there. That tells us 73 based on this time frame. If we look at the daily time frame, you can see this head and shoulders, shoulder, head, and shoulder right in here. This height is about 85, let's just call it, and we'll be conservative down here and call this 79. So that's 6 points from there. That also measures out to 73. That doesn't mean you buy at 73. It means that that's where there's a potential for support, but look for evidence of support. Look for evidence that the buyers are taking place if you're going to make a high-risk long trade. And all long trades are riskier in a downtrend. So if you're going to be trading from the long side, do it with smaller share size. Be extra quick to cut your losses. And the message of the semiconductors continues to be just horrible as well. The semiconductors, a lot of people were looking for that 450 level to be support. It continues to be very weak. And this is, when the semis broke down, I was thinking, well, it's odd that the rest of the market isn't following it. Well, maybe they weren't initially right away, but the rest of the market has been following these semiconductors, and these guys have been leader to the downside, and this group also suggests further selling to come. This group was down over 2% once again today, and looking for evidence of a bottom in here looks to be it's a loser's game trying to look for a bottom. Wait for it to materialize, and then see. In other words, wait for it to materialize on the shorter term time frames. And if you're going to take those trades, be very cautious about trading them. Again, right in here, this is where people thought that 450 level was going to act as support. It broke down through there, and now we're basically in the give-up stage here in the semiconductors. I think they can continue lower. I don't know what they're going to do. Nobody does. But clearly the path of least resistance is lower, and the trend is your friend or your enemy if you're fighting it. So continue to basically obey the direction of the 5-day moving average, I think, is the best way to really continue to look at this market. Now the Qs are probably the strongest in here recently. They're only down 1% today only, but still it looks to me like just the lack of a bounce in here and the fact that this prior bounce right in here came up to approximately this area where we had that prior support. We remain below the declining 10 and 20-day moving average, that 50 days flattening out. I think it's inevitable that we test the 200-day moving average near 48 in here, and it seems as though the downward momentum is slowing. That doesn't mean that there's any reason to buy in here. Perhaps if this market can make it past, I think, just to be safe, probably about 50.5, then maybe we're going to get a little bit of a squeeze higher of those shorts, and maybe another test of this level up here near 51.5 to $52. Looking at the weekly time frame, we have come down pretty sharply in here, and it wouldn't be surprising to see a rally maybe up towards there again. But there's no evidence of that potential bounce occurring right now, so continue to just trade what you see, and keep all these other tools at your disposal to look for other evidence, like the MACD divergence or maybe diminishing volume on a test of lows. But that's not a reason to buy. The only thing that pays is price, and defense wins the game.